This final chapter, Chapter 6, contains 4 quiz questions to test your understanding of the materials covered in this module. Question 1. A company has 100 million common shares outstanding and net income for the year of $1 billion. The company has also granted 30 million fully vested stock options to its employees, struck at $50, and the spot price of its stock is 62.5. What are the basic and diluted EPS figures the company must report for the year? Here are the 4 permissible answers. Solution to question 1. Basic EPS is calculated as net income divided by shares outstanding. So 1 billion divided by 100 million, or $10 per share. Diluted EPS, in this case, requires an increase in the denominator, calculated under the 2-step method described in Chapter 4 as follows. The additional shares to include in the denominator equal the total shares that would be issued if all options are exercised, step 1, minus the shares that could be repurchased with the proceeds from option exercise at a spot price of 62.5 under step 2, which comes to this quantity here, or 6 million additional shares. So diluted EPS is now 1 billion divided by 106 million shares, i.e. $9.43 per share. Therefore, the correct answer is B, as in boy. Question 2. Which of the following statements is most accurate about the accounting for an own equity forward purchase contract? Here are the 4 permissible answers. Solution to question 2. As discussed in Chapter 2, IAS 32 specifies that the contract is an asset or liability if it settles on a net cash or net share basis. If it settles on a gross physical basis, it is an equity item that gives rise to a liability on the balance sheet. Therefore, the company cannot avoid recognizing an asset or liability on the balance sheet under any of the 3 alternative modes of settlement. IAS 39 specifies that changes in fair value must be recorded through the income statement under net cash or net share settlement, but not under gross physical settlement. Under gross physical settlement, unless the issuer elects fair value accounting for the liability, only the interest expense is recorded in the income statement. Therefore, by opting for gross physical settlement and electing to use the effective interest method rather than fair value accounting for the liability, the company can avoid recording changes in the contract's fair value in the income statement. Therefore, the correct answer is C. Question 3. When an issuer sells its shares for forward settlement, as opposed to purchasing them, and elects gross physical settlement, IAS 32 classifies the contract as an equity instrument only, so that the only entries that are recorded occur at settlement of the contract and require debiting cash and crediting equity. Using the same data as in Chapter 2, assume an issuer enters into back-to-back 1-year physically settled forward contracts on its stock, purchasing the stock under one leg and selling it under the other leg. Which of the following statements is true? Here are the 4 permissible answers. Solution to question 3. We explained in Chapter 2 that when the forward purchase is settled physically, a liability is recognized on the balance sheet, and that interest expense from the liability accrues and is recorded in the income statement over the life of the transaction. We also explained at the beginning of this question that under the forward sale, the only entries are balance sheet entries that occur on the settlement date. Therefore, interest expense under the forward purchase is recorded, but no offsetting interest income under the other leg. Therefore, the correct answer is D, as in David. Question 4. Under the total return swap described in Chapter 5, which of the following is most accurate? Here are the 4 permissible answers. Solution to question 4. Clearly, the dealer has wrong-way exposure to the issuer, since a sharp fall in the price of the issuer's common shares would give rise to a large gain under the total return swap, just when the issuer's credit quality is presumably declining. The reverse is unlikely to be true. There is no necessary connection between a rise in the issuer's share price and the credit quality of the dealer. And as mentioned with the forward contract, it may even be possible to eliminate the issuer's exposure to the dealer entirely by depositing the shares in escrow. Therefore, the most accurate answer is C. This completes the quiz, as well as part 2 of this module, and brings us to the end of our discussion of own equity transactions.